I like to say it's a hurricane over real estate right now.
I do think the economy is weakening, and I have some concerns.
Two influential figures in the world of finance, Bill Ackman and Barry Sternlicht, are sending out urgent warnings about the real estate market. Ackman, the CEO of Pershing Square, a highly respected Wall Street firm, cautions about an imminent wave of real estate bankruptcies. His concerns highlight the potential for massive economic repercussions, with hundreds of billions of dollars at stake.
What's going to be interesting is to see what happens when people have to reprice their debt, and I think that can have sort of a cliff-like effect, and you're certainly seeing that in real estate.
On the other hand, Sternlicht, the CEO of Starwood Capital Group, an investment fund managing over $120 billion in assets, compares the looming crisis to a Category 5 hurricane.
Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Their warnings serve as a crucial reminder of the potential challenges ahead in the real estate sector. Now, let's delve into their perspectives to better understand the gravity of this unfolding situation. But before we do, don't forget to hit that subscribe button. Stay tuned until the end of this video to learn more about what this means for you. So, to figure out what's brewing in the real estate storm, we need to see how it connects to another key player: interest rates. Real estate is like a piggy bank that gives you a steady stream of cash year after year. Think of it like a predictable income, similar to a job salary. For example, imagine you own a small apartment building. Each year, it throws off $100,000 in rent, like a steady wage coming in. This is what we call the income stream of the building. Now, subtract any costs you have for things like repairs, taxes, and upkeep. That's your net income from the building. Now, here's where interest rates come in. Imagine you get a chance to buy another apartment building just like yours. But this time, you need to borrow money for it. The amount you have to pay back each month, the mortgage payment, depends on the interest rate the bank charges you. If interest rates go up, your monthly mortgage payment goes up too. That means you have less money left over from your building's income stream. It's like your salary getting smaller. This smaller net income makes the building less attractive to buy, and when something is less appealing, its price usually goes down. That's why higher interest rates often lead to lower real estate values. So, when Sternlicht talks about a Category 5 hurricane, he's worried that rising interest rates will tighten belts for many real estate owners, leading to potential price drops and market slowdowns. Consider a $100,000 a year apartment building. The rent rises by 5% each year, similar to a raise at work. After 5 years, we sell it for a nice profit. But how much is it worth right now? That's where cap rates come in. It's basically a way to estimate a property's value based on its yearly income. Think of it like a price-to-earnings ratio for stocks, but for buildings. In our example, we'll use a 5% cap rate. So, we take the building's yearly income of $100,000, divide it by the cap rate, 5%, and boom, we get the estimated value at $2 million. But wait, we're not done yet. Remember inflation? Money today is worth more than money tomorrow. So, to get the real value today, we need to adjust for that using another concept called discounted cash flow. Basically, we imagine taking all the future income from the building and bringing it back to today's value. We use an interest rate, let's say 6%, to do this calculation. After all the math, our little apartment building is actually worth about $2.28 million today. Let's see what happens when the interest rate storm hits. First, we bump the discount rate from 6% to 7%. Imagine this like a higher time machine tax for bringing future income back to today. This shrinks the building's value to $2.18 million, a cool $100,000 less. But the storm isn't over. Investors want a bigger piece of the pie now, so they demand a higher cap rate when they buy the building in 5 years. We bump it from 5% to 6%. This means the building will be worth less at that point, further reducing its present value to $1.89 million. Let's keep going. We crank the discount rate to 9% and the cap rate to 8%. It's like a hurricane of interest rates. This time, the apartment building's value plummets to a shocking $1.41 million. See how even though the building's income stayed the same, rising interest rates caused its value to seriously drop? That's why Sternlicht and Bill Ackman are worried higher rates can shrink the value of many real estate investments. They think the good times in real estate, healthy cash flow, won't last, leading to a possible U.S. recession. It's all about supply and demand. Rising interest rates might scare off borrowers, slowing down new construction. That could mean less supply, potentially pushing rents higher and keeping the real estate market afloat, at least for a while. But if the economy sputters and people lose jobs, suddenly we could have too many apartments and not enough renters, driving rents down and dragging real estate values with them. A healthy real estate market means more people want apartments than there are available. High demand, low supply. That's like a long line outside a popular restaurant. Landlords can charge more rent because everyone wants in. Over the past few years, things were booming. Strong economy meant more jobs and money. Government gave extra cash to people. Home prices shot up, leaving many stuck renting. All these factors led to higher rent prices and made apartment buildings even more valuable. However, the tables can turn quickly. When the economy slows down, people lose jobs and can't afford their own places. They move in with family or roommates to save money. Some even get evicted, reducing the building's income. These things mean fewer people want apartments. Meanwhile, remember all those new apartment buildings planned during the good times? They're finished now, adding more supply to the market just as demand drops. Think of it like bringing pizzas to a party after everyone's already full. This pushes the supply line to the right, creating a glut of empty apartments. The result is much lower rent prices. Sternlicht is especially concerned about two types of buildings: offices and retail spaces. First, the elephant in the room: remote work. Sternlicht thinks it's a big deal in the US, where many people haven't returned to their offices. But, he points out, that's not the case everywhere. Places like Germany have low vacancy rates, meaning most offices are filled. People are back to work. Even the Middle East and Asia have busy offices. It seems remote work hasn't taken hold as much there. So, what's Sternlicht's prediction for the US office market? A two-tier system: high-quality buildings. These modern, attractive offices, like the one we're in, will probably stay full. People enjoy coming to work here because it's a pleasant experience. Average and below average buildings. These older, less appealing offices might face trouble. They could become empty, like fields of grain, leaving no choice but to turn them into parks or something else entirely. For some C-class buildings, it's cheaper to tear them down than keep them empty. Sad, but it might mean more parks in the future. One question on everyone's mind: will houses get cheaper? Sternlicht, a big-time housing owner, believes prices might fall eventually, but it's a bit complicated. Why prices might hold. Interest rate hikes have made borrowing pricier, discouraging some homeowners from selling and buying new places. This keeps available houses scarce, and scarcity tends to keep prices up. Many homeowners secured low mortgage rates before the hike. They're less likely to sell while those rates still benefit them. Why prices might drop. If interest rates decrease again, some homeowners might finally decide to sell, flooding the market with more houses. This could push prices down. As things stabilize, construction companies might start building more houses again, adding even more supply and potentially dropping prices further. Billionaire's prediction is that the housing market might just stay stuck for a while, with prices neither rising nor falling dramatically. But in the long run, he expects them to go back up. Looking to buy a house? You're not alone, but getting your foot on the property ladder is tougher than ever in the US. Why? Two main reasons. One, homes are ridiculously expensive. The average cost has gone from $315,000 in 2018 to a whopping $416,000 in 2023. 2. Remember those super low mortgage rates a few years ago? They're gone. Rates have doubled to around 7%, making borrowing much more expensive. So, what does this mean? Housing affordability is at a historic low. Many Americans are simply priced out of the market, and worries about a housing bubble are growing. We might expect high interest rates to crash prices, but something unexpected is happening. Turns out, folks with low-rate mortgages are stuck, like they're wearing golden handcuffs. Selling would mean leaving behind those sweet, sweet low rates, so they're keeping their houses off the market. This lack of supply, just like in our supply and demand example, is keeping prices stubbornly high. So it's important to remember that when the real estate market gets stormy, it's not just about a few guys making more money. It can have a big impact on everyone, the rich and the not so rich. We need to think about both the good and the bad when things get wild in the housing world. The next year and a half could be bumpy, maybe even a hurricane, as Sternlicht says. But here's a ray of sunshine. If you can ride out the storm till 2025, there might be a pot of gold on the other side. Remember, investing is a marathon, not a sprint. To discover more financial insights, especially from other financial experts like Warren Buffett, check out the video on your screen. Keep learning with us. Thank you for joining us. Until we meet again, start small, think big, and stay financially enlightened as you build your future.